Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is our week in review for the week ending July 3rd, 2026. I'm Haley Kuhn with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Head of Applied Research and Analytics. On the macro side, the early week data gave us a familiar mix. Manufacturing is still expanding, but losing a little momentum. The labor market still looks resilient, but less clean. Housing remains stuck in a low transaction, low affordability environment, and construction spending is barely moving. So not exactly a recessionary backdrop, but also not the kind of data that suddenly makes the rate story easier for CRE. And that fits pretty neatly with this week's commercial real estate headlines. We'll start in New York, where the rent freeze for stabilized apartments and Sergey Brin's reported exit from an A&E real estate multifamily fund both speak to the continued pressure on rent-regulated housing. Then we'll move to retail, with Kroger's planned acquisition of Giant Eagle and Target's latest round of new store openings. We'll also hit Digital Realty's $3.5 billion buyout of Blackstone's stake in 3 Northern Virginia data centers, which is another reminder that data centers are still attracting big institutional capital. And then we'll walk through a very 4th of July appropriate data segment, talking about the original 13 colonies, 250 years of American real estate history, and what those markets look like in CMBS today. So Stephen, start us off with the macro setup. What stood out to you from this week's data?
All right, I'll take the macro. I gotta say, Haley, I'm pretty excited for that 13 colonies piece because it's not every day you get to celebrate 250 years of the greatest country in the history of the world. So I hope that's getting our listeners amped up because this is a fun segment we have prepped for this week. On the macro front, though, this is a good snapshot of where we're at right now. The economy is still expanding. Friction from higher rates and higher costs is obviously still showing up in the data in various ways. Manufacturing is probably the cleanest example. ISM manufacturing came in at 53.3 in June, down from 54 in May. So we're still expansionary but cooling. New orders are still positive. Production is still positive. But shocker here, prices paid remain elevated. So it's not a bad report. It's just kind of, I think, confirming what most of us feel like we know in our hearts about what's happening with the U.S. economy right now. The labor data was similar. ADP showed 98,000 private sector jobs net in June, with pay up 4.4% year over year. So that's a solid gain. And at least to me, that speaks to some of the efficiencies that we're able to eke out in today's economy with AI, right? AI is able to boost pay without being inflationary because your marginal output per employee is on the margin improving. JOLTS showed job openings basically unchanged at 7.6 million and hires unchanged at 5.2. So labor's not breaking, but it's also not accelerating. And consumer confidence ticked up only modestly, with some deterioration in how consumers view the labor market. That's actually, for me, where probably the biggest surprise and also concern is. The economist expectations were for a much stronger consumer confidence improvement this month because, well, gas prices eased. And usually when gas prices ease by as much as they have in a short period of time, you tend to see a bigger consumer confidence boost. We didn't get that. So obviously the pressures are much more ingrained in what the consumer is feeling. And Lonnie, you and I talked about this in the Market Pulse. That's, I think, what we should be watching for later on this summer is the back to school shopping. That's probably the strongest signal we're going to get and the most important one outside of the holiday spending we'll get later this year. We also got some residential data this week, and I think it tells an interesting story.
Yeah, so for the consumer confidence, I fully agree with you. I was surprised to not see that tick up more than it did. I think people have just come numb to the gas price, whether it's up or down.
Yeah, Lenny, there's 2 areas of the market that even though I've traded billions of dollars in bonds, or at least, was hoping to execute that much. There's 2 sectors on Wall Street I will never, ever touch and never, ever pretend to even want to try to become an expert in. 1, oil prices and gas prices. I get run over every time I think I can even begin to play in that arena. And 2, currencies, exchanges. No way get run over in both of those areas.
So let's talk about the New York City's Rent Guidelines Board vote to freeze rents for roughly 1 million rent stabilized apartments.
Yes, the New York City Rent Guidelines Board voted 7-1 to freeze rents for roughly 1 million rent stabilized units. handing Mayor Zoran Mondani an early policy victory in fulfilling one of his central campaign promises. Now, Lonnie, I think we know who that one no vote was, and I don't believe that one no vote is still hanging around. Their exit note that was openly published hints at the possibility that maybe this freeze won't stick, but it's going to be a long, hard battle to be fought to reverse this. The freeze applies to both 1 year and 2 year leases signed between October 1st, 2026 and September 30th, 2027. The article here notes that this is the first time longer term stabilized leases have been frozen. Now, tenant advocates celebrated this move as much needed relief, arguing that renters are still dealing with elevated costs for food, transportation, and other necessities while wages have failed to keep pace. Landlords in the real estate industry have pushed back sharply, saying owners are already being squeezed by rising insurance, tax, energy, maintenance, and repairs costs. We've talked about that a ton at Trepp, and we'll be doing a lot more work to come that's going to quantify exactly what those increased costs look like on a line item by line item basis. One landlord representative on the board resigned before the vote, criticizing the process as overly politicized and warning that owners would not be able to cover these rising expenses. I guess maybe I should reverse that comment earlier that it wasn't the person that voted no that left, but anyway, I'm still pretty sure we could guess who the one no vote is. Now, RE, B, and Y warn that the freeze could reduce investment in maintenance and repairs, potentially accelerating deterioration in the city's regulated housing stock. I don't think we have to guess here. We know that's what's going to happen. That's what's always happened every time we've had this sort of freeze or this sort of regulation on rent increases. So what's going to be really interesting to watch here is we've already seen this pretty sharp and severe increase in loan distress for that older rental stock in New York City. So can it go higher, Lonnie?
Not can it? Yeah, it's going to.
It will.
This is a self-fulfilling prophecy here. I mean, it's just such a bad look for everyone. Listen, I'm all for creating affordability for folks. I'm all for having nice quality places for people to live. I think that that's important for a strong economy to have affordable housing where people can live and work and play and do all the stuff that they want to do. The approach that they're taking here is so far from achieving that. It's just, the part we talked a little bit about this on our Market Pulse webinar this week is it's become so performative and it actually invalidates the entire creation of having these types of boards or committees that are actually supposed to be objective, independent, making decisions based on data. This is all political theater. And the owners of these properties, they're literally seeing any equity, if they have any left at this point, evaporate because of regulation. They're not going to be able to maintain the properties. They're not going to be able to provide the type of housing they want to for their tenants. And for tenants, it doesn't end with a rent freeze. And this is the part that I think is just an interesting dynamic is, if you have someone that struggles with drinking, there's an adage that says one beer is too many, 100 is not enough. And it's kind of the same thing here with these rent freezes. Like the rent freeze is too much, but it's not going to make the tenants happy. They're just going to latch on and push for more. And it's just a slippery slope. So I hate seeing this in New York, that just the numbers are staggering here. And we'll see how it plays out. I think we know how it's going to play out. There is a remedy for this. It's called building new inventory. It's called supply side. We've seen it play out across the U.S. in free markets where the industry, overbuilds and rents come down. And that's how it's supposed to work. So, the dynamic here, the interesting is that the woman that resigned and then published her resignation letter online. To your point, Stephen, it leaves a lot of interesting tidbits kind of out there as to potential next steps for this. And I don't think this is over, but that then creates more of a distraction and more headlines and more nonsense. Like people are supposed to just do what they're supposed to. And if they come to a conclusion that the rent should be frozen based on data, all good. That's what they're supposed to do. When they do it, when a candidate runs for election and then appoints 6 new board members who by definition already have cast their ballots before they even take the vote, just not a fan.
No, that's not a good look. Now, we got a really interesting data point that kind of validates the type of distress this sort of policy creates and what New York City has been struggling with. And first off, I got to say, hats off to The Real Deal for a very cute title here for this article. The world's third richest man can't hack New York City rent stabilization market. And they're talking about Sergey Brin. Really cute because, well, let's face it. If the guy wanted to, he could hack probably a lot of stuff, quite literally hack in computer terminology. So he reportedly sold his stake in A&E Real Estate Multifamily Fund, and he sold that back to A&E at a steep loss. with A&E saying the investor accepted 6 cents on the dollar to exit the New York City multifamily sector. 6 cents on the dollar. That's an insane loss. Now, this is an obvious sign of stress in New York City rent-stabilized multifamily that has been hit by higher expenses, limited growth, regulatory pressure, and capital improvement needs. All stuff that we've talked about. And Bren is not the only institutional investor tied to the fund that's taken pain. So the general takeaway here is that it takes extremely deep pockets, persistence, and honestly, a good amount of intestinal fortitude if you want to persevere in New York City rent-stabilized. And even then, it still may not be enough. There's a lot of factors working against a lot of folks in this city. And it's really unfortunate to see this rent freeze take effect because, like we're talking about, it can actually work against the goals of providing affordable housing.
Yeah, I think it does work against the goals of providing affordable housing. Imagine if you're a developer right now and you have something that's not quite finished. Like, what's the likelihood of at some point during your ownership of the city council and the rent guidelines board figuring out a way to come and put your property subject to these same types of things? Like, capital's not going to stay here and invest in this. Like, multifamily in New York City is going to be impaired as long as these regulations and these rent stabilization and other things are in effect. It's just, look, they're going to try to get this back in front of the Supreme Court. They need to try to get it back in front of the Supreme Court. This, by definition, is a taking. It's not legally allowed. The Supreme Court hasn't ruled on it in the way that they should, but this is black and white. Like, this just is not supposed to. Property rights are inherent in the U.S. It's one of the things that makes the U.S., and they have had a taking and without just compensation. And so, we'll be talking about this for some time to come because it's not going away. I'm afraid it's going to spread to other parts of the country. And listen, if you're someone running on a political ticket and you know that you have a disproportionate number of people that are frustrated with cost of housing and housing options, this is a pretty surefire way to get votes. And it's not ideal. I think there's a compromise. I think there's a way to get this legislatively, enacted where owners can still maintain viability of their buildings and tenants can actually see more rent reduction and better renting experiences. But this clearly is not it. So, 6 cents on the dollar. I mean, luckily for him, this was a small investment, $79 million, valuation on his investment. It's not even a rounding error, but it's just indicative. Like, banks are going to be in the same spot. They're going to be holding loans on buildings that don't have market value. There's no exchange value in the marketplace for them.
For somebody that has the capacity and the wherewithal to withstand these sort of losses, to still walk away, that's a telling sign. Now, on a more positive note, rather than divesting for, well, really not positive reasons, we have Kroger in the news. Thankfully, again, looking to make another acquisition, maybe this time successfully. They're looking to buy Giant Eagle for around $1.65 billion, including cash and assumed liabilities. And that deal would expand Kroger's food and pharmacy footprint across several Midwestern and Mid-Atlantic markets. Giant Eagle is a privately owned regional grocer with nearly 200 supermarkets across Western Pennsylvania, North Central Ohio, Northern West Virginia, Maryland, and Indiana. The company also operates 11 standalone pharmacies and generates roughly $9 billion in annual sales, giving Kroger a meaningful regional platform with grocery, pharmacy, private label, and loyalty program strengths. Kroger's board has already approved the transaction, and the company expects the acquisition to close sometime next year, pending regulatory approval. Now, remember, Kroger already tried to make another acquisition and got shot down spectacularly during the regulatory approval process. So this is far from being a done deal, but given that we've had an administration change since then, maybe there's a little bit more hope for a positive outcome this time around. Kroger expects the deal to be accretive to adjusted earnings per share by the second full year after closing, excluding transaction and integration costs. The companies expect only limited store divestitures to satisfy regulators, which is notable given the scrutiny Kroger faced around its prior Albertsons merger, which, if you recall, back then, they initially were expecting to have to divest 200 to 400 stores from Albertsons' footprint. So this is perhaps a much more likely transaction to close, given that lack of overlap. Kroger shares were down nearly 3% in pre-market trading following the announcement, suggesting investors may be weighing integration risk, regulatory uncertainty, or broader concerns around the grocery sector consolidation. Lonnie, you think this one's going to close?
Look, I hope for Kroger's sake that this one closes because they spent a bunch of time and money, as did Albertsons, on the last deal that did not get regulatory approval. This one, I think, has the markers of something that should be much more satisfactory in the sense that there's not so much geographic overlap. You're not talking about closing down huge amounts of stores to make this deal work. And, I think, the fact that the company that are acquiring the Giant Eagle, is a privately owned, just kind of a regional grocer makes this much more palatable. Listen, I think it takes some conviction on the part of Kroger to just jump back into this again, because that was a pretty painful experience with the failed Albertsons merger. And so these things don't happen without significant costs. I mean, imagine the lawyer fees and all of the monies that get tied up into these large scale transactions. If it doesn't close, there's no refunds for that. I mean, like, you're just out of pocket. So I'm hopeful for them. We'll see if this gets favorable treatment, at least, regulatory wise. I think it should. And, it's good. I think, listen, if you're the owner of Giant Eagle and you've spent, decades building this out and you're able to sell and walk away with 1.65 billion, that's what the American dream's all about. Feels like a pretty good story for them.
So one more story here across property types. We saw more headlines for data centers this week, and we talked about this earlier, but let's dig into Digital Realty's plans to buy out Blackstone's majority stake in 3 Northern Virginia data centers for $3.5 billion in cash and stock.
Yes, this portfolio totals 288 megawatts of capacity spread across 2 96 megawatt facilities in Manassas and 1 96 megawatt facility in Sterling. The assets were developed through a 2023 Digital Realty Blackstone joint venture, under which Blackstone held majority stakes and Digital Realty handled construction and operations. The facilities are fully leased to 3 different investment-grade tenants, which makes the deal less of a speculative development bet and really just a stabilized hyperscaler ownership play. The transaction gives Digital Realty full control of the Virginia assets, buying out Blackstone's 80% stake in the 2 Manassas facilities and a 50% stake in the Sterling facility. The 3 data centers are still under development, with 2 expected to be fully operational in early 2027 and the 3rd to reach full capacity in 2028. The companies value the 3 properties at $7.8 billion, including debt and remaining CapEx needed to complete development. Digital Realty will pay Blackstone with $1.2 billion in cash and $2.3 billion in Digital Realty stock, so Blackstone retains exposure to the company even after selling its direct JV stake. So this is a clear sign of continued strength of hyperscaler data center demand in Northern Virginia, especially for large, fully pre-leased projects backed by institutional grade tenants. So it's just absolutely wild to me to see the dollar amount of these assets. I mean, this is still, every time I read through one of these articles, it just is absolutely mind-blowing to me, Lonnie, how quick this asset class has evolved and how fully unprepared so many of us are to ultimately analyze and value these assets.
Yeah, I mean, look, this is kind of a learn as you go, and we're seeing that play out real time. And just the numbers involved with these are just so astronomical, both on the power side and the pricing side. It's just remarkable. I mean, at our Trepp Connect conference, it was remarkable just listening to the bank lenders talk about how they maybe have exceeded exposure limits or ratios with one data center deal because they're so large. Like they're having to syndicate or take these out to market or whatever. It's a really remarkable phenomenon. And it's just going to continue to grow. I mean, I hope this isn't one of those things where it grows until it just stops and reverses immediately. We've talked a little bit about that and the possibility there, but I don't think the markets reacted very positively to this. That was kind of surprising. I think Digital Realty was down after the announcement. So, I don't know if people felt they overpaid, if they didn't like the Blackstone trade here. Like, I'm not sure what the cause of that was, but it wasn't met with positive interaction from the marketplace.
Now, I just want to toss out one other quick hit because we just rolled into July. We saw a headline about Target's July 2026 new store opening. So I just wanted to mention this one. Target announced that they're opening 11 new stores in July 2026 with locations in Arizona, California, Colorado, Florida, Kentucky, Massachusetts, South Carolina, South Dakota, Texas, and Utah. The stores officially opened July 26 and are part of more than 30 planned new stores in 2026. 2026. So this will be fun to watch as we roll into the back to school shopping season. This is clearly Target trying to basically make sure they're in the right place or the right places at the right time and can execute on their strategy, because heaven knows the stock market has been very critical of Target's continued turnaround and redirection.
Yeah, they've found themselves as what used to be kind of the premier shopper experience storefront to something that's kind of sandwiched between Amazon and Walmart, who's really reinvented itself with some of the AI connectivity that they've created and the drone deliveries and other things. But to your point, Stephen, this is part of Target's broader $5 billion capital investment plan that they're rolling out in 2026. So listen, we're all hopeful and optimistic that this may be a catalyst that turns Target's prospects around.
So let's get into one of our main topics for today's show, a special digging through the data. I'd say one of my favorite things about this show is we really get to use Trepp's data to tell a story. And with the 4th of July this week, Stephen, you put together one of the more unique segments we've done. You looked at the original 13 colonies, how those commercial real estate markets have evolved over the last 250 years, and even found some active CMBS loans on some incredibly historic properties. So walk us through this analysis and some of the history.
Yes. So this is really fun. I mean, 250 years ago, 13 colonies declared independence and set in motion the longest running experiment in democratic commerce the world has ever seen. So let's move to the data. We took the original 13 colonies and mapped them to their primary modern MSAs. Then we pulled active CMBS exposure across those markets. Private label only, so conduit, large loan, and SASB, no agency debt. And the point is to see how those founding markets stack up in the securitized commercial real estate world.
To our listeners out there, if you can't tell, Stephen is super jazzed about this segment. He is ready to go.
It's always interesting when we get into the deal level statistics. So what we did is we pulled data on active CMBS loans with a year built prior to 1890 with balances over 50 million. 27 properties came back. 3 of them tell you almost everything you need to know about what 250 years of American real estate looks like in the modern securitization market. These are super fun ones. Property 1 here, Lonnie, is the Hotel del Coronado. Granted, that's not part of the founding 13. We're talking out there in San Diego, California. This property was built in 1888, and it's a large one. This is the marquee name in our data set. So the Hotel del Coronado opened in 1888 on a peninsula just south of San Diego. It's one of the last surviving examples of American Victorian seaside resort architecture. It's a national historic landmark. It appeared in more than a dozen films, and as of late 2025, it has $970 million of CMBS debt on it. Almost a cool billion. Yo, that's solid. Something built in 1888 that's worth almost $1 billion. That's pretty cool, I gotta say.
Well, I'd say it actually is worth more than $1 billion because the loan is 970, right?
Sorry.
I think, so it's, you know, if you say that's at 60% LTV, you're talking about $1.5 billion in value. It is pretty remarkable. I mean, it just highlights the intrinsic value of real estate and the staying power that it has, especially, you know, things like this that have been renovated but maintained kind of their, you know, aura that was part of the historical component. And so this one is not unique, although the size of it and the loan balance and property value is. But it's great to see, you know, something built that long ago still being viable in today's market.
I mean, it tells you just how calibrated my mind is to think only about what the debt is valued at, right? So I'm glad you caught that, Lonnie. That was a very significant slip up on my part. So this is an interesting one. It's a Blackstone-owned deal, specifically BSK Dell Partners. This was put into BX 2025 DELC. So that's a fresh SASB securitization that closed in December 2025. It's a floating rate loan, 2-year initial term with extension options that can push the maturity out to 2030. The current LTV is 57%. The NOI debt yield comes at just under 13. And what's really interesting about this deal is that the hotel was built in 1888, 6 years before the Pullman strike, 12 years before the Wright brothers flew at Kitty Hawk, and nearly 40 years before the Great Depression. It's outlived every major financial crisis in American history. That's wild to me. Now, one thing I want to flag for our listeners who follow SASB deals specifically, this $970 million loan was used to refinance Blackstone's prior $950 million loan and cover closing costs of $20 million. This floating rate loan was priced at a spread of just over 245 basis points above the 1-month term SOFR. an interest rate cap of 4.25, which results in a max loan rate of a little more than 6.70 with 18 months of remaining term, 3 years of extension options. The maturity is really not immediately in view, but what'll be interesting to watch is the RevPAR growth and how that holds up. At issuance, the RevPAR on this hotel had been growing around 4.5 to 4.6 on a compound annualized basis since 2018. That's solid top line growth. So I'll be curious to see how this property progresses.
Yeah, I mean, this one, in addition to its age, the location is, remarkable. So I think this one has staying power on the RevPAR side, just because it's an iconic place with real demand driver behind it. So I think it's definitely something to keep an eye on, but I wouldn't be surprised. I mean, if it's held up 4.5 to 4.6% since 2018, there's no reason to believe it won't continue that.
Now, our second property here is dialing back the clock a little bit more. 55 Wall Street in New York City, built in 1842. So this is 55 Wall Street in Lower Manhattan. Right? This is the home of the Merchants Exchange, which is one of the earliest purpose-built financial institutions in the U.S. It later became National City Bank, then Citibank. Today, it's been converted into Cipriani Club residences and event space, and it's part of the Cipriani New York City portfolio loan that's in CMBS. The loan here is $90 million, consisting of 3 senior pari passu notes split across 2 deals, though in practice, when you look at it, it really just looks like 2 split pieces in 2 deals. And this has 2 properties backing it. The Cipriani Wall Street property at 55 Wall Street is one of them, and the other is Cipriani 42nd Street. The Wall Street property accounts for just about 36 points, and the 42nd Street location is 63.3%. The loan rate is 8.6% fixed, maturing in September of 2028. Property is 100% occupied with a single tenant through June of 2029. Now, here's where it gets interesting. This loan is on the watch list. DSCR was underwritten at 1.81 times based on net cash flow. At year-end 24, financials showed net cash flow of about 0.6 times coverage to 0.7 times. There's a little bit of disagreement between the reporting on the 2 loan pieces here. Now, year-end 25 financials improved to 1.35 to 1.37x. Again, a little bit of difference between what's getting reported on net cash flow. The servicer is flagging that reported base rent continues to come in far below what rent rolls show. They've contacted the borrower multiple times in 25 and 26, and the gap between reported income and rent roll just hasn't been resolved. So that's a watch list flag you typically want to keep an eye on just to make sure everything is still kosher with the financials and the loan performance. So you have a building that was constructed in 1842 as the financial nerve center of a young republic that survived the Panic of 1857, the Civil War, 2 world wars, and the 2008 financial crisis. And today it's sitting on a CMBS watch list because of, well, a basic income reporting issue. So history meets modern credit surveillance. Now, the third and final property is my favorite of all of these. It's the historic Inns of Annapolis in Annapolis, Maryland, built in 1727. 1727. That's wild. This is also the property that sits as part of the most distressed loan of these 3. So the historic Inns of Annapolis at 58 State Circle in Annapolis, Maryland, it really consists of a couple different build dates. It was built in 1727, 1772, and 1776. So it was built in phases. So that initial year built is 49 years before the Declaration of Independence was signed. That's crazy to me. The Maryland State House, the oldest still functioning state capitol in the United States, sits directly across the circle. These buildings have been at the literal center of American political life since America existed. Words just can't describe how mind-boggling that is to me, to have a property with that rich of history.
Yeah, it's pretty remarkable. Just reflecting back on some of these buildings, I mean, effectively being built, almost 50 years before the Declaration of Independence is pretty remarkable. And I think the thing I marvel at most is just how they've been able to maintain, as I said, on the hotel out in San Diego, their viability, because what was built back then was not built for modern use like it is today. I mean, like it's incredible, engineering feat that these things are still, functional. It's great historical significance, but it's not without its share of challenges, as evidenced with this property.
Yes, and this story has some twists and turns. So the historic Inns at Annapolis is part of the Ashford portfolio, which is the 2018 8-property SASB hotel deal that Ashford Hospitality securitized in 2018 at $316 million. Now, this loan matured in February 2020, but that was its initial maturity date, and this loan had multiple extension options that could push its fully extended maturity date to February of 25. Well, the loan hit that and did not pay off. So it went into special servicing in March of 25. 2025, transferring due to imminent monetary default. And as of the most recent reporting, this is now 76 periods past its maturity. Special servicer is CW Capital. Current LTV is 88%, and the NOI debt yield is 7.5%. Workout status still listed as other or TBD with an estimated time to resolution of 9 months. We always take that with not just a grain of salt, but sometimes a tablespoon of salt. It takes a while to work these deals out oftentimes. Now, the commentary from the servicer is what gives you really the most complete performance picture. For the 12 months ending in February 26, the historic Inns of Annapolis achieved 58.1% occupancy, an ADR of 192.91, and a RevPAR of right about $112 for the trailing 12 months in February 2026. That's down slightly compared to the performance in February of 2025, which had occupancy at 61.6%, an ADR of almost $197, and a RevPAR of just over $121. So this property is losing a little ground even as the broader hospitality market recovered. And if we zoom out and look at the performance for all 8 properties in this portfolio, it's kind of a mixed bag. You have half the portfolio, or 4 properties, showing a year-over-year decline in occupancy, in ADR, and RevPAR, and the other half showing an improvement in 2026 relative to 2025. The historic Inns of Annapolis, you have an 18th century inn complex, buildings that hosted colonial Maryland's political elite that watched the Continental Congress meet that predate the country they're now securing debt in. And today, that debt is 76 months past maturity, sitting in special servicing with a servicer who is still trying to figure out how to resolve it. Whether historic Inns of Annapolis stays in that portfolio or gets carved out for individual disposition is one of the more interesting workout questions in the hotel CMBS space right now. Because a lot of times, you see these hotel workouts end up carving out individual pieces and trying to resolve this piece by piece by piece. So there you have it. 3 properties built in 1727, 1842, and 1888, all carrying active CMBS debt in 2026, one performing at nearly 13% debt yield under Blackstone sponsorship, one on the watch list at 55 Wall Street, with a borrower reporting a gap the servicer can't seem to close, and one in special servicing in Annapolis, 76 months past due, that's needing to be worked out and will continue on for the near term. Now, the broader story that I'd leave with our listeners with this is this. The founding cities that bent towards trade and finance, specifically New York, to a lesser extent Boston, have the deepest CMBS markets and the most capital access. The cities that bet on office as their primary asset class, including Philadelphia, Baltimore, and Hartford, are carrying the most stress, and the southern colonies are the ones that were the agricultural economies in 1776 and are the growth story of the modern securitization era. Georgia and North Carolina have more dynamic CMBS pipelines today than what you're seeing in Pennsylvania and Maryland, and that's not a result I'm guessing our founders would have predicted, but perhaps in large part do. And this is where the fun comes in, Lonnie. Here's that little tidbit that's, well, really basic, but not obvious. My guess is that the growth of the Sunbelt is in large part due to the invention of modern air conditioning, right? If you think about what's happened and when, think specifically like Miami, right? Would Miami have been viable without air conditioning? No.
Yeah,
I don't believe it is.
Not to the level that it is today. And even, look, they don't have the best air conditioning in Miami, but it's a requirement, I think, for a lot of these Sunbelt states, especially, we didn't talk about anything to the west, but you get out to Arizona, et cetera. I mean, air conditioning, those markets would be almost uninhabitable without air conditioning at this point.
Yeah. And that's just the fun part of living in commercial real estate. New technology can sometimes unlock massive growth potential and enable massive gains over the long run. So the question I have today is, how will AI and some of the electrification we're doing and the energy revolution that we might see, how will that reshape commercial real estate?
I think that's a deep question, and we'd love to have our audience chime in. So email us podcast@trepp.com and share your thoughts on that.
So I know we had some really dense data in there for a number of these loans. So if anybody wants to get the details in written format, absolutely reach out to us at podcast@trepp.com. Let us know what you want to get in written format, and we will get it back to you. I have this all teed up. It's all there. I am more than happy to share because we had, well, a little bit of a different stretch here, but I felt like this was something fun, an opportunity for 250 years.
And we have some programming notes this week. We released our latest CMBS delinquency report, so go check that out on our Trepp website or our LinkedIn page, or reach out to us at podcast@trepp.com, and we'd be happy to share a copy of that with you. On Wednesday, July 8th, We are taking part in a webinar with our partner, Eisner Amper. Lonnie will be joining Eisner's Lisa Nee to talk all things mid-year commercial real estate outlook. We also have a joint research report that we've developed with Eisner Amper. So if you're interested in joining their webinar or seeing that research paper, please reach out to us at podcast@trepp.com and we'll make sure you get access to those materials. Turning to shout outs, Sander B is an avid listener of the podcast and was interested in our CRE debt universe reports and our loan tenure reports. Michael M is a longtime listener of the pod and was curious to know how we're integrating our data into LLMs and any AI tools, and specifically our MCP servers. So Michael will be in contact with you, and if anyone else is working in any AI tool and curious how they can embed Trepp's data within their instance, please reach out to us. We'd love to walk you through it. Nicole D loved our guest episode that we just released with David Harrison and was really excited to hear that we started that episode off with a quote. That was something new that we tried. So check out our guest episode with David Harrison. He gave a really excellent look into the state of the servicing market, shared some misconceptions, what he's looking ahead towards in that industry. And we have a lot of exciting guest episodes coming in the near future, so stay tuned for those. Susan G was very interested in our 30% acquisition signal report that we released. We also talked about that on the podcast several weeks ago. So if you liked that podcast segment but haven't seen our research yet, reach out to us at podcast@trepp.com and we'll make sure you get a copy. Jonathan G also thought that report was interesting. Lauren C commented on David Harrison's episode and said this was an excellent guest episode. Franz B told us that the 30% analysis was really interesting and was exactly why he loves following our work. He immediately remembered the podcast conversation with Lonnie and Steven and liked to see it in written format as well. We heard from our friend Jeff W on LinkedIn, and he gave a shout out to episode 403 of the podcast and said, "We did a very nice job of capturing a theme that tracks closely with what we are seeing across his practice right now, talking about why private credit is so prevalent in the market for CRE deals, with banks increasingly lending to private credit lenders." So we got a lot of great feedback on that segment last week. Another shout out from our friend Trey W on LinkedIn, who does a weekly listen segment in his newsletter, and he also gave us a shout out for episode 403. He said this is a fresh episode and the recent commentary about WARSH and inflation is well worth the listen. So thank you, Trey, for the shout out. And as always, thank you to our listeners for tuning in. Happy 4th of July, and we hope you enjoyed the show.
Yeah, I did want to close with a little bit of reflection here, Haley, as we delve into the July 4th weekend. And, as America 250 years old, I think it's important for us to recognize that things sometimes get lost in the daily noise of markets, politics, and relentless pace of business. We cover that on our show, and even today got caught up in a little bit of the political theater that takes place. But in reality, we get to live and work in a country that in the 250 years has built the world's largest economy in the history of human civilization, created a capital market system that funds innovation at scale that no other nation has matched, and produced, a real estate market that's generated more wealth for ordinary people than any other asset class in the world. And we get to cover it, talk about it every week, write about it, be part of it. It's incredible, but none of that was inevitable. I mean, all of it was earned. So as we kind of head into the weekend, this July 4th, I can speak for myself and our team here. I know that we're all genuinely grateful, not just for what the country has built, but for the freedom and the framework that made it possible to build it. So, as we head into this weekend, I do think it's important that, we take some pride in the fact that we get to live, work, play, and have friendships and relationships and all this stuff in a country that allows individual freedoms and liberties that just hasn't been matched across the world, even in spite of some of the headwinds and some of the negativity that's out there in the world. It's not invisible. There are still many things that we could do better in this country, but on the whole, it's a really remarkable thing that we get to experience. I know I'm happy to get to experience the 250th anniversary. It's pretty remarkable. And, Stephen gave us a great historical context today and some of the stories, but it really is traceable back to the early 1700s on some of these real estate deals, and it's pretty remarkable that we get to talk about that. So hope everyone has a great weekend. enjoy the fireworks, have some hot dogs, swim in the pool, have some fun, and be proud to be an American.
And with that, we'll close. Thanks to our producer, Carly Sento. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.